All right, welcome back, everybody. This is meeting seven, getting close to the wrapping up point in our class. We do have a full agenda today, so let me talk about the agenda first, the logistics, a little bit about the course. Let me open up my notes. Um, Today I'll be wrapping up. Remember, last week we finished the case, but we didn't touch one last question on the valuation, and that was the price that the company should be willing to pay. So I'll come back to that particular discussion. I'll spend a little time there to wrap up that course. I will do the quiz one review, and I'll talk about the logistics for quiz two, which is coming up next week. Actually open up today. And your last assignment, which will be due in 2 weeks. Okay. So so that would be the quiz one review. I'll talk about quiz two. We will have the case, the U.S. Bank. That's the topic for today are the sources of capital for corporations. Okay. The case is about borrowing. That's the debt part. And that's the most common for most of the companies in the United States, obviously. But I will talk about the raising capital on capital markets for larger companies, like selling equity on the capital markets. So by necessity, I'll be talking about investment banking. So that's the part of the financial industry that helps big corporations to raise money. So that will be more of a qualitative discussion. You don't need to calculate anything. So that will be the source of capital discussion. I will do the corporate finance kind of wrap up the valuation, add a few of the details. I'll finish up what we did last week. Remember, we talked about the capital structure. So corporations need to decide how much money to borrow versus to issue equity. What's the optimal mix? And how that changes the discount rate and obviously the valuation of the companies. Okay, all of this will be touched on today as a wrap up. Okay, and what's next week? Um, you do the quiz. Quiz two. I'll talk more about the questions on the quiz. It's mostly about valuation. So I do like to have everybody do at least one exercise on the valuation. So that will be you would still be doing the levered unlevered betas, but with the purpose of discovering the discount rate and applying it to calculate the present values. Okay, so that will be the quiz two. It will open up today after class and will stay open until Tuesday of next week, end of the day Kyiv time. All right. And that will give me a couple of days. I don't think I'm going to finish grading before our class next Thursday, but it will give me a chance to look at your submissions and I will do the review in class of quiz two. All right. A little bit about the logistics of the quiz. I typically like to upload your files. So I ask you to submit Excel files with your calculations, but it turned out that Moodle doesn't have a functionality for me to upload your files. So I was able to post the grades. You see the grades. I posted the quiz solutions. It's in last week's material. All right. So if you didn't notice, it's posted there. And I will, when I make my weekly announcement, I'll point out that solutions to quiz one have been posted, but I was unable to upload what I typically do. I grade, I mark your mistakes, and I upload your file so you can look at your mistakes. That functionality is not available on this platform for whatever reason. I teach typically on a different platform. So unfortunately, I wouldn't be able to upload files for the quiz two either. All right, I will post the solutions after the quiz is closed next Tuesday, and I'll go over the solutions in class. So you will see your grades, but unfortunately, I would not be able to upload individual grading to the platform. So if you would like to see your mistakes, reach out. I have those files. All right. Another quirk in the grading, again, this is the limitations of the platform. I would need to rescale your individual project part one, which I gave you. Remember, it was on a scale from 0 to 100. Okay. And in the grading, it said 5% will be the part one and 15% part two. So altogether, that's like a 20% component of your grade. Well, if 100 is 5%, so 15 should be 300. Well, your platform allows me go up to 200 points. All right, that do not allow me to put 300. So what I need to do, I need to rescale the first part to 50, and your second part will be scored 150. Everybody follows? Don't get too hung up on it. But altogether, the proportion will be correct. But I would need to rescale your first part back to maximum 50 instead of 100. So don't get upset if you see half of your grade someday in the next few days. Metro.
It sounds too complicated, but I recall on some exams we had like 400 points per exam.
Again, I do not know. I tried to put 300 for the quiz two, and it says the maximum is 200. So I don't want to do the separate research how to find that particular points. It's easier for me just to rescale it and put 150 points for the quiz two. I don't think that's just don't get surprised. Okay, that's the only thing. All right. Um, so that's on the logistics. So um, let me see if I need to do one more thing. So next week, I will ask you to read two cases. You don't need to submit anything except quiz two by the end of Tuesday, but do read those two cases. One is on the dividend policy, so that will wrap up the corporate finance policy. So again, in corporate finance, we try to solve three questions: the investment question, the financing question, the debt versus equity, and the third one, when everything is said and done, how the corporation is distributing earnings to shareholders. Okay, so that's the third question. We'll discuss it qualitatively mostly next week. I'll walk through a few slides. We'll talk about the case, dividend policy at Linear Technologies. Just to read, just to get a sense how U.S. companies pay dividends, what are the issues there, how they approach this. Okay, that would be the first part. The second part, the second case I ask you to read. Ideally, you should try to solve it. It's Kerr-McGee. We actually talked about this when we talked about relative valuation. I showed you relative valuation for Kerr-McGee. Okay. That's where I'll be talking about corporate restructuring and how activist investors, in this case, Carl Icahn, pick companies to target to change their strategy. What's the financial analysis behind this? So it's an interesting case. And in that particular case, the financial approach is somewhat different. Remember last week we talked about corporate valuation. So we projected the cash flows, you calculated the discount rate, you put it all together, calculated the present value of all cash flows that corporation is expected to produce ever using the growing perpetuity. A different approach, and that's something that I work very often, is a unit of analysis is different. Not the total company, but one unit of production. So for that particular company, it's an oil company, and that unit of production is 1 barrel of oil. So what do? You project cash flows for 1 barrel of oil. You discount it back to present. You calculate present value of 1 barrel of oil. And then how do you do the company valuation? You multiply by the number of barrels the company is expected to extract. Okay, so a unit of analysis is different. The process is the same. All right. In my world, in banking, what's the unit of analysis? one loan. Okay, so when I do my analysis, when I calculate NPV of a project, I calculate NPV of one loan. So I project cash flows for one loan. I discount it back to present. I calculate present value of one loan. And how do I do the total project analysis? I multiply by the number of loans I expected to book. Okay, so it's very common in some industries to use the one unit of production as your unit of analysis. So I think that would be interesting exercise for us to go through. So I will demonstrate it. If you're ambitious enough, you can try to do it on your own for the case. But I will obviously walk you through the Kerr-McGee and the reasoning behind why Kerr-McGee in that particular case was attacked by activist investor. What was the reason? And it's directly tied to the NPV that they produce for one barrel of oil. So you will see how this works. Okay, so I think that will be an interesting exercise to wrap up, and I'll try to leave typically some time at the end of the lecture, a last lecture for the Q&A. So if you have any questions you would like to discuss we didn't touch on in this seven meetings, send me your questions. Okay, send me your questions ahead of time by email for the Q&A, and I'll pick those questions and address those in class. Or just show up with your questions next Thursday. Hopefully we'll have enough time to cover that. Okay. All right, so that will be, I'll remind you in the class announcement. Loans are given under equal conditions. So again, when I do, let's say, a marketing department question was, are those different loans? Absolutely, they have different loans. So I'm in business lending. I pick a business loan, which are typically, very similar. All right. So I pick one type of loan. Obviously, I don't do one loan for the whole company. Okay. I pick one type of a loan. I calculate present value of a typical loan in this program, and then I calculate the NPV of the program. Okay. And for each product, that will be a different process. Okay. For each loan, for each kind of service that is provided. Yes, that would be the unit. All right. So let me do this. Let's wrap up the case from last week, the Mercury. So let me do this and talk a little bit more about the price. Okay, so the question is how much to pay. So let me review briefly what we came up with. And so let me step back and do the, so we calculated the DCF, standard DCF, calculated the free cash flows, applied all of the adjustments. We walked through this last time. We used the terminal value as a growing perpetuity. Okay, discounted all of the cash flows and then made some adjustments based on other assets and other liabilities. All right. So that was the value of the company, $277 million, 278, somewhere there. I'll come back to the sensitivity analysis for the relative component. So terminal value was calculated as a multiple of EBIT. And remember, we removed one company from the sample because it was much, much bigger than others. So that's the approach. And in this valuation, it was 413. And how do you decide what is the appropriate amount? Obviously, there is one more with synergies. You have another 50 plus million coming out of the synergy. So if not for the merger, this value would not be created. Okay. So it's only after buying the company, the buying company can create synergy and extract more value. All right. So we have several different numbers. And how do you think about this? So we start with 278. All right. So this thing is not just a technical exercise. And by the way, make sure when you submit your work, in the future, do spend a couple of minutes on formatting. Some of the groups submitted this, it was pretty unreadable. All right. So make sure that your illustrations are not all, but some of the groups kind of skip this step. So how do you think about this? So our discount rate is about 11 12%. You see the values here. All right. So some of you argued that well, if this is the valuation, the company should go can go up to this $400 million mark. Okay. So how do you think about this? You step back and you say, all right, what combinations in a DCF, or the growth rate, and a discount rate will give me $400 million? All right. And if your discount rate is between 11 and 12, you actually do not see 400. Even with 5% constant growth rate, you're still below 400. Okay. So you would have to move down to a lower discount rate to see more than 400 million range here. Okay. So that's where you have to start thinking, can we lower the cost of capital? Is it practical? All right. So that's where the sensitivity analysis comes in a big way. That's the reason companies do this. All right. To see, all right, how much can we pay? So we came up with the kind of standalone value of 278 million. But anything above this will you would have to push either the growth rate up or the discount rate down. All right. So that's where the sensitivity analysis comes in. All right. And in general, the company should stay as close to this amount as possible. Okay, so that's the value that comes out of the kind of the fundamental analysis, the DCF. All right, every dollar you give more than this, what happens? You pay to the selling company more than the value, the basic value of the company. So absolutely, if you really would like to pursue this acquisition, you can go somewhat higher than this. Okay. But in general, so if you have a valuation of, let's say, 270, and what did we have there? 400, let's say 410. All right. So obviously there is a synergy there. So for 60, well, you try to stay as close to this value as possible if you are buying. All right. Every dollar you pay more than 270, you will give up the value to the selling company. All right. And obviously, do not give up any synergies because they would not exist if you do not buy the company. And there is absolutely no sense to pay this much because what happens? You give up all of your potential value to this selling company. All right. So, and a typical reaction, if you see, no, this week, two banks are merging. Fifth Third is buying Comerica. Those two mid-size banks in the United States. And what typically happens at the announcement? The target company, the buying company, the Fifth Third, offered a 20% premium over the current price. So obviously, the share price jumps 20% of the target company. What happens to the buying company's share stock? Typically goes down.
Why? It's
Based, yeah, go ahead.
overpaid.
Yeah, based on academic studies, the buying companies typically overpay. All right, not always, obviously, but in the desire to buy the company, they go to the limit. And what happens? All of the benefits of the merger goes to the target company rather than the buying company, which will create the synergies. Okay. So again, based on multiples, that's what people in academia, the finance professors, that's what they do. They study this. They collect data, they look at the price paid, and then they follow this company for a number of years and see what happens with the stock price of the buying company, and it doesn't perform well. Okay. And the reason for that, they overpay. Okay. So that's the idea behind, yes, you pay the full price, otherwise nobody will sell to you. All right. And in that particular case last week, the Mercury, remember there was multiple companies potentially could buy that Mercury. And if the seller goes to the auction, what does it mean an auction? Instead of directly negotiating with the seller, the selling company says, I'm selling this division, I'm selling this Mercury, anybody wants to buy. So what happens, a lot of companies will review this and start bidding. And that's where the overpayment typically happens. If you open up for bidding, instead of directly negotiating with the kind of the management of the selling company, that's the bad way. So that's another downside for that acquisition. If the seller goes to the auction and tries to sell that division through the auction vehicle rather than direct negotiation, the buying company is should stay away. That's the very typical scenario to overpay and give up all of your synergies to the selling company. Okay, so that's the considerations that companies have to go through and decide what is the best strategy for them to pursue and what's the price. So they have to have a maximum price they're willing to pay. Right? Over that, there is no reason. So again, giving up the synergy values makes absolutely no sense because those synergies would not exist if there is no merger. Okay, Metro?
Well, purely, I think, mathematical question. Still, if we buy and split the synergy, we could make some money on other part of synergies. If we don't buy, we don't make any money of it. No?
Okay. So think about this. Again, we talked about the one-handed economist. Did we? I think so. So no, that's an economic joke. You should know that. It's attributed to President Truman. It says, find me a one-handed economist. What do you mean one-handed? Because every time you ask a question, you get an answer. On one hand, this will happen. On the other hand, this will happen. So find me one-handed, so I have one answer, not two answers to the same question. So again, two hints here. Yes, you're right. The synergies will not be created, but there are the synergy and there are the synergy. So depending on the source of synergies, what's the most typical source of synergies? When two companies merge, our economies are 70% service, providing services, not making things. All right. So making things, you can think about economy of scale, building bigger plants, and so on. But in services, what's the biggest expense?
Client base.
Salary. Salaries.
Well, if you run a company, think about your company. What's the biggest expense for your company? People. You're paying salaries, you're paying benefits. That's typically the biggest chunk of expenses because that's a service. You need people to provide services. Okay. So where is this savings are typically coming from? So let's talk about the Mercury. You're buying Mercury. How many CEOs do you need? 2 or 1 for the combined company? Obviously 1. How many accounting departments do you need? 2 or 1? 1. Okay. You might add a few accountants to support the new division, but you do not need 2 accounting departments. You do not need 2 heads of accounting departments. So you will fire that person, head of accounting, head of finance, head of marketing. So, but the savings, think about this. If the CEO is making $1 million a year, you didn't say 1 million. How much did you say? It's 1 million this year, next year, the following year, and so on. You save $1 million in perpetuity. If you literally calculate that $1 million divided by the discount rate, that's a $10 million savings in perpetuity. Everybody follows? Same thing with multiple people that would be employed by that a separate company that you do not need. Yes, you need. We talked about the marketing department, so you might not run different products, so you might increase your marketing department significantly, but you do not need finance department and accounting department, the human resources department, 2 of them. You might marginally increase each, but not double it. All right. That's where most of the savings. Okay. Can you calculate this fairly reasonably accurately? Can you calculate the savings? Yeah. It's, you have the salaries. You assume some kind of increase in salaries for the next or that whatever in perpetuity. You calculate that savings. That's a permanent savings forever. You can calculate the present value of perpetuity. That's your synergy. And how difficult is to achieve that? How difficult is to fire people? Not difficult. All right. So
In Ukraine, it's difficult.
Okay. I think if you run the company, you'll find a way to do this. All right. So you'll figure it out. Now, let me finish. So that part of the synergies is pretty easy to estimate. The other part of synergies, when companies merge, they say, we will increase our sales. That's a more difficult part. Okay? Because there, to increase sales, that means somebody has to give up sales, some other companies. You bump into competition. Okay? That is more difficult component of the synergy. You can promise anything you want to a financial community, but that's a more difficult part to execute. Okay, so that value of the synergies is more speculative. Flip.
Yeah, Professor, I would like to ask, isn't there an obligation for the company to pay twice salary or 3 times salary even in the event when they are firing people?
All right, and that's why you have something called the merger expenses. You have to pay those laid off people compensation, but it's a one-time thing versus what? Every year you save that amount. So obviously a one-time payment, however big that might be, will be smaller than the value of the perpetuity, which is based on this amount. All right. So yes, typically companies that merge, they budget, big budgets to pay off, people to leave. You talk about golden parachute. Somebody asked early in the course, what's a golden parachute? Typically, let me spend a little time on this. When companies merge, the way, like with Mercury, typically you reach out to the managers, the senior management, the CEO, and the key people, and say, we would like to buy you. And the management might say, no way, we want to be independent, we'll fight this. Or they might say, sure, let's negotiate. And typically, if the management says no, the buying company very often goes away, because otherwise you have something called a hostile acquisition. What does it mean, hostile? The management doesn't like you. They don't share the information, because one of the key items during the merger, they say they sign NDA, non-disclosure agreement. So the buying company will sign NDA and get access to all financial information, financial and production information. So they can figure out what's the true value. Because your project, which is due in 2 weeks, you're not an insider. You have the public information. You're trying to figure out what's the value of the company. It's much easier and much more accurate to do this from inside. You go inside, you look at inside information, you gather that production information, financial information, and you do a more accurate assessment of the value. All right? In a hostile environment, that just doesn't work. Okay, so you don't have access to that information, and many companies are not willing to take that risk. All right, so that's the considerations that you have to take into account as well. When I joined the bank many years ago, the bank was recovering. It was a buyer. There was a hostile acquisition. Wells Fargo bought another bank, and that bank didn't want to get acquired. There was a hostile acquisition. Wells Fargo was successful, but hostile acquisitions in service industries is very tricky. So what happened? Wells Fargo bought another bank called First Interstate Bank, and what happened? Senior management just left. And imagine this scenario. You have an account at the Target Bank. You have a lunch. You go to your ATM, your bank, at the cash machine. You want to take $20 for your lunch, and ATM says, "I'm not working." You go into the branch, and people in the branch, say something like, "Well, we don't have access to the data. Everything is shut down." Are you happy as a customer? No. So what happens in a hostile acquisition, when the senior management, they knew they will be fired. They didn't wait. They just turned around and left. And the whole thing just collapsed. It didn't work for 4 days. That was enough for the Wall Street to say, you cannot buy companies. You don't have the expertise to do this. So eventually Wells Fargo was acquired. All right. So after I joined the bank, but that's a different story. So hostile acquisitions are very difficult to pull out. Okay, you can do it, but it's a much more difficult proposition. All right. And the last comment I would like to make on a technical part, how this works. So again, that's kind of the general view. You try to stay as close to the kind of standalone value. You can go a little bit above, but nowhere near giving up the synergies. The process itself, just to make sure I mentioned this. So this is the buying company. Okay, this is the target company. All right. So you have the assets, you have the debt, and you have the equity. All right. A direct way is for the buying company to raise capital, again, borrow money or issue equity or do a combination. So raise funds and buy so this is the assets, and you have the debt, and you have the equity. All right. And go raise money and buy the equity in this company, and they take control. So 50% plus one share gives you formal control of the company. Not always, all right, but that's a formal approach. Some companies can throw up defenses if they do not like to be acquired, because you can go to the market and in the open market to buy 50% plus one share, you formally get control. But a multitude of defenses exist. So sometimes a target company will say the board of directors is staggered. You cannot replace a board of directors in 1 year. You have to wait 3 years. So that's 1/3 of the board of directors is replaced every year. So you would have to wait 3 years to get control. So that's one of the defense mechanisms. All right. So that's one thing. But let's say it's a friendly merger. The management is willing to negotiate, they agree on the price. But a typical arrangement, technical arrangement, would be something like this. A buying company, they will create a subsidiary, a separate legal entity, and they will make an investment. So they will make an investment into this company and buy 100% of equity. So that's they are the owners. And they will have cash here. They will provide cash to this company. Now, this subsidiary on its own can borrow money, and the total amount will be paid for the equity. Okay, it's called a triangular acquisition. So you have the three entities. Okay, the reason for that is the following, especially in certain industries. Think about one of the case we studied in a previous class. I think that was Oracle buying Sun Microsystems. Okay, and at some point, those computers, the hardware, developed a problem. They were burning. Their batteries were bad quality, and they were burning. So the reason to go through this legal structure, okay, a separate subsidiary, which is 100% owned by the parent company, is to do what? They buy the company, they will roll this financials into this company, but legally that will be a separate structure. But in case this company has some undisclosed liabilities, okay, bad product, something that might happen in the future, legally, the buying company is protected. So if there are any problems, that will be the problem of the sub. And if it goes bankrupt, it doesn't take down the parent company. So that's the kind of the typical arrangement that companies go through to avoid liabilities of the companies they acquire. Okay, so in some industries, it's more important than others. So obviously, you involve attorneys, legal companies. They will help you through this process. They will set up the legal entities. They will do the negotiations and so on. So that's the kind of the side of the mergers and acquisitions that we don't go into a lot. We did the financial analysis, but that's an important part of the whole process. So I just wanted to make sure you are aware. So when I think I mentioned when I worked in the UK, I worked on getting the banking license in the UK, and one of the requirements from the local financial authority was provide a list of your subsidiaries. So I went to my legal department and said, "Can you send me a list of subsidiaries of Wells Fargo?" You know how many companies were there? 700. All right. So I said, "Here, have it." So I set it up. That's the way it was structured in the past. It's much more simplified now, but at that point, that was the structure. So every time a bank will buy another bank, they will create a separate legal subsidiary to hold that bank. Okay, that will not be wrapped into one big legal entity. All right. So that's the wrap up. Let me get into quiz one. I want to very briefly review quiz one, Mitro.
Yeah, brief question. If we create subsidiary to hold the target company, doesn't we give up all the benefits of the merger because subsidiary has to have its like CEO, has own departments, finances, etc. No?
Did we talk about Apple and how much Apple pays in taxes?
Not much.
Okay. Apple has a legal entity in Dublin, Ireland, that collects all of the royalties. So Apple has a lot of patents. Okay. And if other company uses Apple's patent, they pay a fee. And think about this, it's a worldwide thing. So companies around the world pay royalties to Apple. And that legal entity is located in Dublin. How much taxes do they pay? Zero, because what? Here's the scenario. And that's what Apple is the biggest taxpayer in the United States. That's the most profitable company. Okay. And the CEO of Apple was dragged in front of Congress, said, you underpaid $1 billion in taxes, because that entity that collected billions in royalties, it's registered in Dublin, but it has no employees. It's just a legal shell. And Ireland has a law. If there is no people, no taxes. How much Apple paid in taxes in the United States based on that entity? Well, you couldn't tax a US entity that is overseas. It's in Ireland. So on the billions of dollars in profit, Apple paid zero taxes. And all of these Congress people said, you cheated the American people. What was the answer? You, the Congress, created the rules. Change the rules, we'll follow the rules. But voluntarily, we will not pay taxes. All right? So you don't have to have people if you have a legal entity. You literally, you would have a CEO of that entity, but even that CEO will not be an employee of that entity. Make sense?
So it would be just a shell for financial statements and legal.
Yeah.
Okay, got it.
All right, let me get a few comments. You did pretty well on the quiz. Just to point out a few things which I think are important. And I'm not going to get into every single detail here. I'll just point out. So you have this scenario. You have a Lithuanian company. And I gave you a bunch of details here on the regressions. The key insight here is the following. Who determines the cost of capital for the company? Whose views are important here? And that's the key. The largest investors are all diversified mutual funds. Okay, what's the relevant framework for them? The relevant framework is the US market, the S&P 500. All right. So the CAPM, as it was developed for public companies, publicly traded companies. So the marginal investor, what's a marginal investor? That's the one who buys and sells securities in the market. Okay. And those are diversified mutual funds. Why this is important? Because if the key investor is not diversified, let's say you have a privately owned company, CAPM doesn't apply. All right. It applies to a diversified investor. Remember how you determine the beta for your companies. You took the returns of your company and ran regression against the market. Again, we don't have the market. We have a proxy, which is S&P 500. Any other indices, So the European index will not work because investors are in the US. That's one. But NASDAQ will not work either. Why NASDAQ doesn't work? It's a big market, but that's not the market. NASDAQ is concentrated on high-tech companies. All right. And theoretically, that's what CAPM is. You run a regression against the market, the very diversified, everything that is traded in an investment universe. Okay, we don't have it, so we use a proxy. We use S&P 500, but that's a big, 500 biggest companies. It's a good representation of the market. Okay, if you're comparing, let's say, technology company to technology company, within the industry, you might use NASDAQ or the technology index. Okay, but for the cost of capital, the relevant entity is the diversified investor. If this is a non-diversified investor, you need to make adjustments. You need to increase the risk. Okay, so directly you cannot apply CAPM. So keep that in mind. CAPM was developed for investors which are diversified, okay, which are not concentrated in one particular industry or segment. Okay? So that's the kind of the theoretical background for this particular question. So the relevant regression will be the S&P 500, not any other of those given. And again, you follow the investor. The marginal investor determines the cost of capital. Okay. So that's an important piece. For the second one, most of you did well. Some of you have forgotten to, so this the share of assets funded by the debt. Obviously, for the unlevered beta, the relevant ratio is D to E. Okay. Some of you applied this ratio, which is incorrect. This is just the debt. You need debt to equity, so that will be debt divided by 1 minus debt to get to the equity. So you would get this ratio as appropriate ratio. Okay. To unlever individual betas, calculate the. I gave you 2 answers here. Again, it's purely statistically, average is, perfectly fine. It's a very small sample. So sometimes median would be a better measure of the central position rather than the average, the mean. Okay. This is a personal preference, but that's, in some industries, it's more common. So where the median typically dominates, in what industry? In real estate. If you buy a property, you try to figure out the value of the property. You typically do not apply the average. You look for the median price in that particular area, because in real estate, what's the 3 most important things? Location, location, and location. All right. So in a particular location, because when you compare real estate prices, you might not have a very big sample. You might have 4 or 5 recent sales. So the median will be more representative of the price rather than the average. Because if you have a big property, its value might pull up the average. All right. So median is typically in real estate, that's more preferred measure. All right. So either one is fine technically, just to make that point. So if you go through the calculations, so again, most of you did this well. So you might have slightly different estimates, and that's perfectly fine. The last one was a little, I thought it was a little convoluted, but I think pretty much almost everybody resolved it. So math is pretty good. As long as you figured out what's the remaining capital structure, I think most of you got this right. Again, if you have questions, reach out, and I'll talk you through the any issues here. Okay, so that's the quiz. So let me just wrap up a little bit to connect this to the current events. So we are not doing this in the discussion in the US right now. So what happens, we talked a little bit about how the interest rates are set in the United States. So the Fed lowered the interest rates. So here's what I'm referring to. This rate, the Fed funds rate, was lowered from 4.5 to 4.25. It's a little bit of a range here, from 4 to 4.25. Okay, so that was the September, and again, that committee of the Federal Reserve meets every 6 weeks. So we have 2 more meetings this year, and the way it works, that committee of 19 people, they meet, they discuss this, they keep the record, and the records, the minutes, released after some period of time, after a few weeks. So now everybody's looking, what did they discuss? What were the details? And I'm not going to get into the politics of this. President Trump is trying to replace some of the members of that committee, and they are protected because the Fed, the board, has a 14-year term. Okay, so you cannot just remove a person. If somebody is appointed for 14 years, can't do anything about it. Okay, at least theoretically. So there's a bit of political fight, so we're not going to get there. But right now, the Fed is going to have 2 meetings this year. And why is this important? Well, if the Fed lowers the interest rate, what happens to the valuation? That's what concerns us. If that pushes down all of the interest rates in the economy, the valuation mathematically has to go up. All right, that's the mathematics of this. All right, and the shape of the yield curve. This is also important. So let me look at this. So the blue is right now. The black is a year ago, and you see on the short end, this is from 1 month to 30-year interest rates. So obviously you have this big shift down, and this is directly controlled by the central bank. They literally control this rate. They can say the rate will be this, and they will target it, and they will move. Okay, and that's what happens. But you see what happened over the year was a 10-year rate. Remember, in our corporate finance calculations, that's the most important part. Did it move a lot? Not really. Okay, so the Fed does not directly control the long-term interest rates in the economy. All right, that's the market. When the market participants trade, so they determine this rate. So a lot of movements on the short end, and that directly impacts my business. So the interest rates on the loans we give to our customers are based on this rate. But long-term rates, that's what we do in corporate finance, and that's what happens in the housing market. The mortgage rates are based on a 10-year. Okay, those did not move much. All right, so right now the Fed is trying to figure out where the economy is and where the economy is heading to decide should they lower the rates or stick with what they have right now, and what are the unknown there? What are the concerns? Well, what was the latest figure on unemployment? And that figure is published every first Friday of the month. What happened on the first Friday of this month?
Shut
The
down.
government is
The shutdown?
the government is shut down. There is no number. Okay, so the Fed doesn't have the data. How do you make a decision? So it's becomes quite a bit of political question. All right, so that's the Fed, is trying to have other, there are some private companies that collect data and try to estimate what's the unemployment, where are we heading with this? Because remember how this works. If the unemployment is very low, everybody is employed, everybody is making money, then the spending is good, that might push up inflation. And the Fed would not like to increase, the odds of inflation going up, so they will stay. But if unemployment is dropping, that means the purchasing power is dropping, the spending is dropping, the inflation will subside. Okay, and inflation report is also not released because the government is shut down, and that's the same agency. That's the Bureau of Labor Statistics. It's a government statistical agency. They collect data both on unemployment and on prices. Okay, that's the same set of people that's supposed to release this data. So again, the Fed is a little bit blind right now. They don't have the latest to make those decisions. So that's the considerations. And for us in corporate finance, obviously, that's an important variable to take into account. All right. So right now, if you within corporate finance, so people are scratching their heads like, okay, what do we do? Right. So a bit of an uncertainty due to lack of data. All right. So as I said, the second quiz will be on the valuation. So let me briefly review the framework, the valuation framework. Okay, and I posted this slide, so you have it. Let me. All right. Yeah, and I will touch on something that I promised, I think last time. All right. So that's the general structure that we covered in this course. That's the income statement. All right. You do a pro forma, so including for your final project, you do a pro forma future income statement. Then you calculate free cash flows. We concentrated on free cash flows to a firm. Let me talk about the other one. So you take after-tax operating income, you make your adjustments, all right? Calculate free cash flows. Then you plug it into your framework. So you calculate free cash flows for a number of years. So you're standing at time zero, and then you forecast your cash flows, and then at the end, you add your terminal value. Okay? You calculate the present value. What the results is the value, the enterprise value of the firm, and then you go through adjustments to minus debt plus cash to calculate the equity value. All right. So that's the general framework. There is another way. So cash flows could be two kinds of cash flow, and we did this. All right. But let me briefly talk about the free cash flow to equity. All right. And what you do there, you actually go down all the way to net income. All right. And then you do the same adjustments. And you come up with a free cash flow to equity holders, not the total cash flow to both debt holders and equity holders. All right. The discounting, that's an important thing. If you do the free cash flow to firm, your discount rate is your weighted average cost of capital. And we went through, multiple iterations of calculating this. If you do the free cash flow to equity, your discount rate is cost of equity. So do not mix the two. So make sure that you are consistent. If your cash flow is to equity, then your discount rate is of equity, not the WACC. All right. Now, why would you do this? Let me put a balance sheet. So again, we have the assets, we have debt, and we have equity. All right. And remember, what's debt? How we define debt. Again, do not make a mistake that debt is a total liability. That's not the case. Debt is the subset of liabilities. That's something that is provided by lenders, okay, by a bank, by a bondholder. And what are the features of debt? You have an interest rate, you have maturity, and a third thing you cannot say in one word, but if you do not pay your debt, what will happen?
Tax shield.
You'll go bankrupt because debt holders will take over your company. So if you are unable to service your debt, bad things will happen. Okay, that's the definition of debt. So let's take banking. You have you have deposit accounts. Some of you, am I right? What's your deposit account for the bank? It's a liability, but is it debt?
It's
Does it
like
have
equity for a bank.
no equity? That's if you own the shares in the bank, you are the equity holder. If you have a deposit at the bank, you are the liability holder of a bank. Okay, the bank owes you that money, but is it debt? Does it have interest rate? In many cases, no. Again, I do not know the Ukrainian, if you have non-interest bearing deposit accounts. So very, very common in the United States, especially if you have a small balance, the bank will not pay you interest. Does it have a maturity? Does it expire? Deposit account? Typically no. Okay, unless you close it, it's going to be there. So is it debt? So you see, for a bank, it might be difficult to find what's debt. All right. So how we do valuations inside when I do a financial analysis, I do cash flow to equity. All right. To avoid this cash flow to a total firm, I have to go around and calculate the net income, make all of the adjustments, calculate free cash flow to equity, and then discount that equity back to present. And I will calculate the present value of equity directly. Okay, it's more complex. I'll show you this in the example. That's why we kind of stuck with the flow to firm, but it is doable, and in many cases, especially this is relevant when. Remember the assumption behind the weighted average cost of capital, that the proportion of debt and equity goes forward unchanged. All right. If that is not true, and the company borrows money to buy another company and plans to repay it, the proportion of debt and equity will change. You cannot use WACC. It will not work. So you have to do cash flow to equity, discounted at equity, but separately calculate the value that will be generated by debt by the tax shield. Okay, so that's this separate, more complex calculation. All right. And just to give you a little bit of a personal story, my first day on the job at the bank, and I joined the Central Finance Group, and it's like 20, 25 analysts and a bunch of managers. It's kind of a consulting company within a bank. So we would help other divisions to do different projects, financial projects, and how the consulting company might work. Some of you might be familiar. It's a matrix system. So you have a number of managers, and you might report to different managers for different projects. That's the matrix. Okay. So my first day, 2 managers show up and say, "All right, here's your first project. You do this a project valuation using the book earning analysis." They turn around and leave. And I have no idea what's a book earning analysis. And that was Monday. So I think, should I quit today or wait until Friday? I'll get paid for a whole week. So that's my consideration the first day on the job. And we have the cubes. You sit next to somebody, and I turn around and say, "What the hell is this book earning analysis?" "Oh, this is the a cash flow to equity analysis. That's how we call it internally. Here's the instructions." So there is a set of instructions that the bank developed over the many years. He gave me that set of instructions, and that's it. Okay, because that's how we do it in the bank. All right, you do cash flow to equity rather than cash flow to the firm. That's all the difference. Okay, so let me walk you through very schematically the difference between the two approaches, and I'll make it available. So if you're interested. So here's the kind of schematically the valuation. You are given the operating income, all right? You have a bunch of assumptions: the tax rate, the debt ratio, the cost of equity, the terminal value calculation. So you have your EBIT. It's increasing at 8% for the next 5 years, and then in perpetuity it will grow at 3%. Very, very standard approach. So you have your EBIT, you apply the tax rate, you calculate after-tax operating income, to make it a little bit bigger, and then you make your adjustments. And I call remember we have the depreciation, capital expenditure, and change in net working capital. In this, in this example, all of them are bunched together and called reinvestment. And that's something you should pay attention. I'll come back to this. The reinvestment. So you take the operating income, and the company must reinvest into its business to grow. How do you increase your operating income? You have to make the company bigger. That means you have to reinvest. So this reinvestment is a combination of depreciation, CapEx, and change in net working capital. So the sum of these three is your reinvestment. And as you can tell, here's the reinvestment, especially in the terminal year. How do you determine the reinvestment in the terminal year? And it's actually a very simple, something that you need to calibrate. How do you grow at 3%? If your expected return on capital is 10.8% in this case, how much do you need to reinvest? If you grow at 3%, you have to reinvest the ratio of 3 divided by 10.8. Otherwise, you cannot grow 3%. So make sure that your terminal year cash flows are properly calibrated. Okay, so it cannot be 0. Otherwise, you cannot expect to grow at 3% forever. Okay, so make sure this details when you calculate the total. It has to be negative. You reinvest. You take it out of your operating income. You reinvest this. That's how you can grow. So make sure this is done. So after you grow faster than terminal growth rate, then at the terminal in the last year, it has to be properly calibrated. But otherwise, you calculate for a present value of all your cash flows, including the terminal value. You have the value of the firm. 20% is debt, 80% is equity. So if you use that percentage, your value of equity is this. All right? If you do free cash flows to equity, you do everything exactly the same, except at the end, remember, as the company is growing, you have more equity and more debt in the capital structure. So how do you maintain that structure? You have to issue new debt to maintain 80-20 portion. So you see, this will be a cash flow to the equity holders because that's the additional debt that the company will receive. So this is a more complex process to estimate what's the cash flow from debt. Okay, that's why it's kind of typically is left out. And in corporate finance, if the proportion is stable, the first part is much simpler to calculate than the second part. But it really doesn't matter if you do it correctly. So this is your equity value. It's exactly the same thing if you do the cash flow to equity. Okay, so the valuation should not change depending on what approach you take, either cash flow to equity or cash flow to the firm with the following adjustments. All right, so make sure this is clear. But one more item to point out, and that's something that you will see on quiz 2. So you will have the standard valuation. I give you this scenario, you build the cash flows based on that scenario, calculate the discount rate, discount everything to present, calculate the value of the enterprise, minus debt plus cash, that's the value of equity. If you need to per share, divide by the number of shares, okay? But this is something that you might try to do. That will be an optional part on the individual project, but there will be a question on the quiz. So let me point something out here, and that is coming back to this. Okay. So I talked about the general framework. So again, the cash flows either to the firm or to equity. Okay, but obviously this requires this additional step on figuring out additional debt that is issued. Okay, cost of capital. I'm not going to repeat. We did this for the case for your quiz 1. So using this template, levered unlevered data. So go through the steps and figure out the discount rate. And again, if you do the free cash flow to equity, this is your discount rate. Now, let's come back to the optimal capital mix. That's the exercise we did last week. How can a company increase its value just by changing the capital mix? All right. So you go through the exercise, you calculate the value of the firm. All right. So in this case, a cash flow to the firm, all of the adjustments, you calculate the value of the firm. If the company can change the capital mix and lower the discount rate, what will happen? So the firm value, if this is in a steady state, remember you take the last cash flow, increase it for 1 year, and discount by R minus G. So this is your weighted average cost of capital minus G. Now, if you can lower your discount rate, you can calculate new firm value. Obviously, you take the new cost of capital. If it's lower, this will go down, this will go up. So you can calculate a value at the optimal where you start to reach the maximum, okay? But here's the thing you can do, especially for your project. And in the quiz, there will be a separate question. If you know the firm value, you know the value of the debt, you know the number of shares, you know the price per share, you can calculate this. This is easily observed. So for your company and a final project, this is the market value of the firm, okay? Now, do you know what's the G in this formula? What is the expected growth rate embedded in the value of the company? Now, think about this. If you know this, and you pretty much can calculate free cash flow based on financial statements, you can calculate the weighted average cost of capital. So if you know this, this, and this, can you calculate G? It's an equation with one unknown. So if you're good with algebra, you can do it yourself. This is a little help. So G is equal to this calculation. What does it imply? So when you look at the value of the company, calculate free cash flows, calculate discount rate, and you can estimate what investors expect the growth rate to be for this company to be worth this much at this moment. You follow the logic? So you can say investors with this price expect the company to grow forever at this rate. And then you make a judgment. Does it make sense? Because remember, what's the reasonable growth rate? If it comes out at 10%, then what? Can any company grow at 10% forever?
Forever? No, for short period, yes.
Okay. So again, the short period, that's your 3, 4, 5 years forecast. But if it's a mature company and you can look at the value of the company and estimate the G, and that G is outside of the, what's a reasonable range?
For debt, it was 5 to 7%, but maybe for growth it's lower, or it's the same 5 to 7.
All right.
3-4%.
Did we use
Three,
Fred?
five.
Did we use Fred in this class yet? You know what's Fred? Fred is your friend. Let me show you. Let me get into an Excel file. But before I do, go to Google, you probably Fred. Federal Reserve Economic Data. Okay, that's Fred. Okay. Federal Reserve is a rich institution. They print money, and they give it for free to anybody in the world. So you can go in and say, I would like to get a 10-year treasury rates, and that will give it to you. And you can see this. You change the dates, you take the frequency, and you can download it and work with it in Excel. So it's a very good tool. So I think any economist should kind of develop a habit of using this. And what's nice about this, Federal Reserve developed an Excel add-in. All right. And you see on my tab, it says Fred right here within Excel. All right. So what I can do, I can say, give me the GDP and get me the data. And it pulls directly from the central bank into my Excel. So let me make some adjustments here. This is a quarterly, GDP is reported quarterly. Let me do this annually. And I don't think I need 1947. Let's do the last 25 years, 2000. Okay. So let me get the data. And this is in billions of dollars. All right. And so let me calculate the growth rate of GDP in the last about 25 years. So we don't have the 25 yet, obviously. And it's always a good idea to graph it and say, all right, here's my GDP growth rate in the last 25 years. All right. So that's what you see. You see the financial crisis goes negative. That's the pandemic. All right. Big drop, big recovery, but we are back to about 4.5%. Again, make sure this is clear. This is nominal GDP. All right. When you see the numbers reported, typically the real GDP is reported. But in corporate finance, we sell our goods and services for nominal dollars. That's why this rate is important. So it fluctuates, but on average, what has been the nominal GDP in the last 25 years, it's about 4.5%. So that's your permanent growth rate, which would be reasonable. okay, in nominal dollars. You should not go anywhere higher, well, much higher than this. Just additional detail there. It depends on the industry. So if you think about, let's say, we'll talk about oil company next week. Can oil company grow at 5% forever? Why not?
Oil is limited.
Anastasia, go ahead.
Sorry, there is only so much oil. It's a resource.
Okay.
I'm sorry, I forgot how to say it in English, but the resource that ends, it's not
Okay.
unlimited.
Do you think we will run out of oil?
Maybe not anytime soon. Not anytime soon.
It's not like you see a picture that this is the last drop of oil. That's it. That's nothing more on this planet. That's not going to happen, because way before that it will become so expensive that nobody will extract it. Okay, but this is decades and decades forward. But more kind of strategically, you have a lot of competition today that comes up against the oil. So a lot of people think that it will gradually decline. Can G be a negative number? Absolutely. In the formula R minus G, if your G is negative, it's minus G. You just make your denominator bigger. The present value will go down. It's not going to disappear. Okay, just to make sure this is clear. You do it within a corporation. What's the latest Apple iPhone? 17? Yeah. Do they think they still make 16
Yeah.
and sell them?
No, they told that
may.
they have already banned
I
the
think
16.
I think in some regions they still make 16 and still sell it. So if you are the product manager, if you calculate the present value of iPhone 16, it's not zero. It's just the growth rate will be negative. It will be declining for the next number of years. So your G will be negative. You plug negative number into that formula, it works perfectly fine. Okay, so make sure this is clear. G can be negative. All right, I do this all the time. So when I look at a portfolio of loans, and let's say we stop offering this particular product, but there is a portfolio still generates cash flows, but the portfolio is shrinking, so the growth rate is negative. I just plug in negative number and I calculate the present value. So make sure this is clear. And a negative number works pretty well. Okay, but it's kind of coming back to this. Some industry might be shrinking. Okay, so your G can be below 4.5% that we have seen in this country for the last 25 years, can be negative. So some people might argue that oil industry, is negative G in a long-term view. But some industry might be more than 4.5%. So think about this. Let's take medical services. As society becomes richer and older, what will happen in spending in that particular industry? It might actually grow faster than the overall economy, and it will become a bigger part of the overall economy. Not by much, you still cannot do 10%. Okay, but marginally, if you calculating a present value of a healthcare company, you might assume a somewhat higher permanent growth rate based on this logic. All right. Questions? So let me see if I covered everything I wanted to cover. So we talked about the case, the pricing, the equity versus firm cash flow, the quiz 1 review of the cost of capital, and quiz 2 again based on the company valuations. Okay, there will be an exercise to calculate a recapitalization, changing the capital structure and changing the weighted average cost of capital based on the capital structure. Okay, The extra credit question will be to calculate number of shares. That's what I did last week. So make sure to review the solution to that exercise. Okay, so the quiz will open after class today, and we'll close at the end of Tuesday next week. All right, so we'll take a 15-minute break, come back, and do the banking case, and I'll talk in general about the sources of capital. All right, let's resume, and I'll get into a few slides to wrap up the capital structure. It is relevant to our next discussion on the banking and borrowing. So how companies make decision on how much debt, how much equity, what's the optimal combination. There are a couple of questions on deposits. I'll adjust those right before we get into the case. So let me get into the optimal capital structure. A few slides. All right. So basic idea, let me reshare. Basic idea is the following. Debt is typically, sorry, let me do this. Typically cheaper than equity. So again, when you do the calculations for your company and you go through the exercise of estimating the cost of equity, cost of debt, so the component of debt is typically cheaper and it's tax deductible. That's the reason companies borrow money. So the value of the levered firm is the value of the equity funded firm. And then for each dollar you have in interest expense, you lower your tax. So that creates a value for the company. And again, don't think it comes from nowhere. The tax shield is savings on taxes. That means the government gets lower revenue. So the source of this additional value, the present value of a company value, is the lower taxes that the company is paying. So that's the source of additional value. And you literally can say this. So this is the value of the assets, okay? And if it's the company is fully equity funded, all right? So this is the balance sheet. But as soon as you start adding debt, you adding something called the tax shield value. So this the tax savings, and that's additional value. So this really increases the value of the company, and it increases the value on this side as well. So this is offset here. All right. But the more debt you add, remember that third thing, the bad things that might happen if you have too much debt, you cannot service it. The value of this is the negative value. You have to consider the potential financial distress. Okay, Mitra?
Yeah, not mathematically, but just in the words, as you were explaining us on the first lecture, that the company paying taxes twice. Like for equity, we pay taxes twice, and for debt, we pay taxes only once.
No.
No.
The double taxation is a separate issue. So corporation pays double taxes on its own earnings, and then the shareholders pay taxes on dividends. That's something that we'll touch on next week when we talk about dividend policy. Okay, this is different. The corporation, it's given, it's double taxation. But the way it works, so let me see if I have this. It's not in this set of lecture notes. So if you think about this, if the company has any debt and has any interest expense, that interest expense will be deducted from net income before taxes, okay, the tax will go down. So the corporation, even though it's double tax, but that first tax will be lower. That's the savings to the corporation. Okay, so the debt creates savings, tax savings, and that's additional value in additional cash flows. All right, so that's a separate issue from double taxation. I hope that is clear. All right, now, but as companies increase their debt, this negative part becomes bigger and bigger. Okay, and so at the low level of debt, so that's when you do this. This would be the optional part for your individual project to see if you add more debt, do you get lower cost of capital and a higher value of the enterprise? Because at some point, what might happen, so here's the graphical representation. If you have a company, this is the value of the company, and this is the total debt. So imagine that there's no debt. You have a certain value of unlevered company. And as you increase debt, since it's a cheaper source of capital, the cost of capital overall goes down, the discount rate goes down, the value of the company goes up. But up to certain optimal point. All right? After that point, the more you borrow, both the debt and equity becomes so expensive that the overall weighted average cost of capital becomes too high, and that will push down the value of the company. Okay, so that's the general concept. All right. On top of that, relevant to our discussion that is coming up is the industry, because how does the industry plays into this game, so to speak? So here's the book value of debt. Again, this is from financial statements of the companies. By industry, what is the proportion of debt? So this thing, debt as a percent of the total capital. So you have the equity and the total value. And you see quite a bit of a difference there, from practically no debt in the pharmaceutical industry to more than 50%, close to 50% in utilities and telecoms. Why is that the case? Why have such a variety of different debt structure, capital structure in different industries? You have to think about, and that's what we're getting into next, is the borrowing part. The lender must be comfortable lending to you. And think about this, telecom and utilities. What's kind of good for lenders in those industries? It's very stable, reliable cash flows. Think about utilities. You have electricity generation and selling. It doesn't fluctuate a lot. Good economy, bad economy. You need your electricity on a daily basis. Telecom. Good economy, you start calling more often your parents. Bad economy, you stop calling your parents. That doesn't happen. So your demand for those services is pretty stable. So they collect payments from you on a regular basis, and lenders, that's what they're looking for. They're looking for stable cash flows that you have enough to repay the debt. And the more stable your cash flow, the more you can borrow. And the more lenders would be willing to lend you. Okay, so that's one of the key considerations on the lender part, the bank or the bondholders, to determine what's the appropriate level that the company can borrow. Why pharmaceuticals have pretty much no debt? What's the thing with pharmaceuticals?
Because people
Risky.
always need to.
Tatiana? Yeah, repeat it.
I thought the first groups of companies, they are quite risky, and most of the time they raise capital from equity, because those people who invest, they invest in innovation, and they are willing to invest and then grow their shares there.
You're on the right track, but why pharmaceuticals are risky?
A long and
Okay.
costly R&D and the success rate is low.
Okay. Good. One more thing. High risk of suing them. Okay. That's another one. What's the other thing? Anastasia?
Maybe there is a lot of competition, like the new generation of each drug comes out, the older one might stop being prescribed.
Okay, so let's see other industries. Retail. You think retail is less competitive than pharmaceuticals? All right. So there might be something there,
It's
but
just more unknown, maybe.
Okay.
It's-
What is unknown?
It's almost always innovation, some patents, etc.
Okay.
So
And
it's
what's
very
what's
different.
important about patents?
You need to be first, and
And
They expire.
they expire. See what happens? And one of the in other corporate finance classes, in the longer one, I have group presentations, and one group once presented Pfizer, which is a big pharmaceutical, obviously, way before COVID. So we're not talking about the COVID shots. There was a statin, a drug, a multi-billion-dollar drug that generated $12 billion in revenue for Pfizer. And when that patent expired, that 12 billion, poof, disappeared. Almost total revenue from that drug gone, because you have generics coming in and replacing the brand name. Okay, so pharmaceuticals are risky in many ways that you already mentioned, but that patent thing, a lot of R&D, a lot of innovation, but the patent is for a certain period of time. They try to extend it, obviously, but if it ends, the revenue can disappear overnight. Okay, so the lenders are not very comfortable with that particular business model. Okay, so it has to be funded by equity. All right. Utilities on the other extreme, very stable cash flows. That's why we see half of the capital comes from debt. All right. So let's move into the case and talk about the banking industry. So I'll ask you to report what you have done for the case. And I will add a little bit. There was a couple of questions on the on deposits, but before, just one question from each group. Let me see. Just one question. Do you approve or decline this loan in this case? Put a group number. Based on your reading of the case and your analysis. All right. 1, 2. Do we have group 3? 6, 7. Anybody from group 3? Guess not.
One moment.
All right, let's move on. An intro, what's the case is all about? And question one, does this loan fits the strategy? Saba, you wanted to start?
Yes. So
And make sure to tell me your group number when you start.
first group.
Okay. Group one.
So in general, this case is about the situation where the vice president of U.S. Bank of Washington is reviewing a loan request to the brewery company Red Hawk, a Seattle-based company, which is a company which was founded in 1981. It is the longtime client of the bank. This company is planning to expand aggressively. It's planning to build 100,000 barrel brewery in Western Washington, 25,000 barrel brewery in Northern California, and they want they need 5 million new equity from their European partner and 6.5 million in bank financing from Washington Bank. So first, we need to understand if this loan fits the strategy of the bank.
Before you get there, a good introduction. What product they trying to expand? What they trying to build? Anybody knows the difference between the lager and the beer?
They wanted lager.
What's lager?
To tell the truth, I am not sure.
Right.
As far as I know, it's a type of beer.
Okay. No beer experts in this class? All right. When I teach in Copenhagen in the summer, they actually have a policy. No more certain number of bottles of wine per lecture. So this is kind of interesting. So we cannot have a beer right now. Obviously, we are in class, but yeah, right. It's a different kind of beer. Typically, it's it is a different product, but it rubs up under the beer moniker. So go ahead and continue. Question.
To understand if the Red Hawk loan fits the strategy, we first need to understand the strategy objectives of the bank. So the first one is that they wanted to strengthen their assets quality and reduce non-performing loans to below 1% of total assets. They wanted to focus on their core markets, Washington, Oregon, Northern California. They wanted to continue to build their long-term relationship with financially stable local businesses in this region. And they wanted to comply with 1992 risk-based capital standards. Next, we need to understand what's the Red Hawk proposal. So as I said, they want to build 100,000 barrel brewery in Washington, 25,000 barrel brewery in Northern California, and they need 6.5 million in bank financing from this bank. They also, as we said, they want to create new product and expand into new markets. So now we need to understand if their proposal fits to the strategy objectives. So first, as I said, Red Hawk is a long-time client of the bank. It wants to expand into the core markets of the bank. So if the deal will be successful, if the expansion will be successful, this opens new opportunities, business opportunities for the bank. But if we need to state that the expansion of the Red Hawk involves high risks, the new product line of the larger new market, and this conflicts with the bank's goal that they want to improve the assets quality and to avoid speculative products. So in general, our group thinks that Red Hawk loan is a strategic fit for the bank, but with some conflicts with financial objectives of the bank.
All right, very good. So group one position is that it's a good fit for the bank, Let's hear from other groups. Can you add anything based on your write-up? You can literally read what you submitted. If you can add any details and flavor to the first question, how good a fit for the bank? First, we'll talk about the financial projections next. From the point of view of the bank, how good a fit of this loan, Anastasia?
Yeah, so basically, we also pointed out that the good signs for the bank were the territory focus, because they wanted to focus on strong local businesses. And the second point for this loan is that it's trustworthy and loyal customer, because it was said in the case that they were pleased with dealings with Redhook in the past. Also, strong business performance is a great plus, because they had, like Redhook had an impressive operating record, which was also stated in the case and in the financial statements. And as for the drawbacks, we pointed out like risk profile, because like the proposed loan may impact banks' typical risk profile, which also was like stated in the case, and it was said that this kind of loans need to be approved by a loan officer, not by loan officer, but by loan committee. Also, expansion outside core market, like it was like the new brewery was not in the bank's traditional Pacific Northwest focus, so it might also be a drawback. And the last point was regarding the Redhook's business performance, regarding historical profitability ratios, but I think we shouldn't go there now.
Okay. What group are you?
Group 2.
Group 2. Andrei?
Yeah, Group 4, I would like to add that the US Washington Bank is steadily increased the share of commercial loans, and as we understand it, that from 1987 to 1989, like this share rose from 53 to almost 56, and the Redhook's case would contribute to this trend of growing share of commercial loans for the bank.
All right, very good point. I'll come back to this one. Ella?
I want to add that we discuss with my group 3. In the case was mentioned that the bank was keen on developing its relation with strong local business, and Redhook Brewery demonstrates significant progress in sale volume, maintained steady net income, and earned on a reputation as a reliable borrower. And this fact provides the US Bank of Washington with solid grounds to view Redhook Brewery as one of the strong local businesses deserving financial support.
Okay.
So we can, it's one.
So it's kind of supporting the idea that's a good fit. That's
good fit for the strategic politics.
Okay. Alexandra?
Yeah, thank you, Group 6. And we would recommend conditional approval. So there are several points of alignment.
Alexandra, let me interrupt you. We're just concentrating how good a fit for the bank at this point. So let's, I'll delay the approval. So if you have comments on the first question.
Yeah, and I can add to that from point of view of the bank, at the 0.1% of the bank current commercial loan portfolio, the loan does not materially affect the portfolio diversification. So this is the good fit because of that also.
Okay, very good. And Mitra?
Yes, Group 7, if I'm not missed, the bank was going to reduce a risk in their assets for a long time, and with this move, the client want to enter a bigger market. If previously he was competing on local craft beer, now he want to build a big factory and become maybe a national, or at least for a few states. And there are a few big strong players inside US and also known brands from Europe who was importing, so they could actually punish it by dumping in prices, and this credit could be risky for a bank.
Okay, so you're talking about the risk component for the
Yes.
bank. Okay, very good. Let me, Anna.
I just would like to add, it's also about this stuff with assets, because US Bancorp have growth in asset, but it's actually was not a favorable trend for it, because it weakened its capital position relative to assets, and so maybe it's not that good to because of the industry. It tries to shift to some residential loans, not to commercial loans. So maybe it's reasonable fit, but yes, have some minuses for the bank.
Okay, what group are you?
Group 3.
3. Let me actually counter that a little bit. So I ask you not to concentrate on the industry as much, more of on the company borrowing, but it is important to look at the industry. So something that, again, you're not familiar with banking, so I didn't expect you to pick it up. But let me point something out based on the industry, and it's specifically bank balance sheet. So let me do this. And I will start with the summary here. All right. So how does the bank make decisions? What kind of loans to offer? All right. And at the time we're talking about, we still have about 14,000 banks in the United States. We still have about 4,000, which is a pretty big number, even today. At that time, many more banks. And how do you decide where do you concentrate? Okay, so obviously the size of the lender. You have big banks, you have very small banks. So depending what do you have experience and expertise, you will be offering this kind of loans. Okay, the geographic area where you are located, what kind of businesses? If you happen to be in Iowa, it's an agricultural economy, so obviously you have to know something about agriculture if you lend money to local businesses. The Northwest that we're talking about, Seattle, the West part, the California, it's a variety of different businesses, so you might not specialize in a particular industry. But overall, and let me very briefly, just to make sure this is clear, the balance sheet of the bank, okay? Again, we're not concentrating, this is not a banking class, just to get an idea. What do you have on the balance sheet of the bank? Obviously, you have cash, okay? You have to operate. This is your inventory, so to speak, all right? So you have cash. You have investment portfolio. So any extra cash, since cash does not generate any income, you will move extra cash into investment portfolio and buy some very safe but low interest yielding investments, typically treasuries. Okay, but the biggest assets are the loans. Okay, loans would be that's something that generates cash flow for a bank. So that will be for a traditional bank, about 70% of all assets will be in loans. All right. And how do you fund it? So you invest your money in loans, but what's the proportion of liabilities and equity? The biggest liability will be deposits. All right. So there was a question of how do you treat liabilities on the balance sheet of the bank. So your deposit at the bank is the liability. All right. And banks also borrow money. They can issue bonds. Okay. That will also be a liability. But the key here is the following. Banking industry is very different. That's why when you were picking companies for your individual analysis, I said no banks. Because liabilities, the deposits and bonds, about 90% of the total. So very, very different. No industrial company can borrow that much. And equity is about 10%. And obviously, you might have heard about something called the Basel Agreement. Basel Agreement is agreement between different countries on the minimum equity that is required. Okay, 8% that happened to be the number, but that's the capital structure of a bank. All right, most of the funding is borrowed either from depositors or from capital markets. All right, most of it from deposits. So banks take deposits. Those are typically insured. In the United States, it's called the FDIC. And in Ukraine, you do have a different government agency. Federal Deposit Insurance Corporation is insuring all of the deposits up to a certain amount. In the US, that happened to be $250,000 per account. All right. So that's the capital structure of a bank. And the loans, the concentration of loans will give you the kind of the insight. Does it fit into the bank strategy? So what helps in this particular case is the following. If you look at the composition of assets, so within these loans, you have different categories of loans. And you have personal loans, you have credit cards, that's a loan. You have business loan to large companies to small companies. So I happen to operate small business lending division within a big bank. Okay, it's a different division within even loans because big company borrowing is different from small company borrowing, and mid-size would be a separate division. Okay, so if you look at the balance sheet, and there is a category of loans called the C&I, commercial and industrial loans. All right, so if you go to the industry balance sheet, you will see the following. The industry on average is in red. So about 30% of all loans in the industry are C&I. Okay, so that's lending to businesses, commercial and industrial. And that will be classified, this particular loan will be classified as C&I, commercial and industrial. What do you see for US Bancorp? It's more than 50%, which means what? What does it imply? That means you have a lot of people working for the bank whose job is to do what? To work on commercial and industrial loans. They have the expertise, they have the people, they have the infrastructure. That demonstrates that the bank is what? Concentrating on C&I loans versus the industry, which has a lot lower balance of C&I loans on their balance sheet. Do you follow this? Okay. And those people have to do something. They're not going to be sitting there and doing nothing. That's their job, is to give out commercial and industrial loans. Okay. So they will be looking for opportunities to lend to businesses. Okay. Because that's their expertise. That's what they do, and that demonstrates that the bank is interested in this particular asset class of the loans. Okay, does it make clear? All right. So that's the kind of additional technical detail that comes out of the case that demonstrate that particular view. All right. Let's move on to the actual analysis of the financials. So who wants to take on the question 2? Mitra?
Sorry, before this, just to clarify, if they have expertise, does it mean that they are happy to increase this share even more, maybe to 90%, 95% of CNI loans? Any threshold for it?
Again, you have to be kind of reasonable. Do you go to 90% CNI loans? You will be very dependent on what? The economic conditions then, all right, in the industry. So what's the other 50%? That's more likely to be personal loans. So what are the other loans that exist? Within personal loans, what do you have? You have mortgages to buy houses, you have the car loans, you have credit cards. Okay, so a bank will be over concentrating in that particular area if you do 90% CNI loans. So let me give you a little bit of an insight. Even within CNI loans, my official office is in San Francisco, but I live in the East Bay. That's across the bay in a small town. And there is another office which I often go to, and that's the office for business bankers. So how does it work? You have people specializing in this kind of work. They work with clients, they determine their needs, and they arrange the loans. And then they go up to, somebody mentioned, this loan must be approved by the loan committee, not one individual loan officer. So the way it works, different banks have different thresholds. Up to a certain amount, one individual, one loan officer can approve it. Say, I underwrite it. Always certain amount, and different banks have different amounts, it has to be a committee, right? One person cannot approve it, all right? So this is a big enough loan, has to be approved by a loan committee, so that's the case. So this building that I go to, I use their offices, and there are business bankers. I talk to them, obviously, and how's business, how things, and they, how's the underwriting. So what happens, they say, everything is good, but we do not lend to hotels. Why not hotels? Well, there is a risk management team that looks at the portfolio. Even within CNI loans, you have different industries that you're lending to. So if that risk management group says, oh, you have too many loans to hotels within CNI loans, slow down. So there will be a directive to the loan officer saying loans to hotels will be scrutinized more than any other. So the risk management, when you say 90% CNI loans, 50, I think it's already a lot. So if you go to 90, you will be over concentrating in that particular asset class, and that's not a good thing. Does it make sense? Philippe, you have a comment?
Yeah, I would like to add that from the case scenario, there was like the overall trend from the banks that they are switching to the real estate and considering CNI loans as risky now because of the crisis which was before. So this might add additional risks for the bank to increase their share in the CNI.
Now, that's true. Banks watch this space all the time. So if they decide to expand, let's say US Bank decides to expand into real estate, they would need to do what? They would need to hire a lot of
new financial directors.
Because you either retrain your existing officers or get one from your competitors, because it's a different expertise. One thing is to lend money to a brewery. A different thing is to lend money to a developer that builds real estate. Okay, it's a different kind of a loan, different risk. You have to have different training. So you either have to hire more people or retrain your existing loan officers. Okay, so it's not, you cannot do it overnight. Okay, Yes, it is possible, but even so, let me even at the Federal Reserve level, they watch the banking space, and that was literally a direction about 15 years ago. You, the banks, you are over concentrated in commercial real estate. So at the industry level, so within the bank, I just show you that risk management is watching a portfolio, making sure that no industry is over concentrating. But even at the bank industry-wide level, you have the central bank, you have the monitoring services. They collect this data from all of the banks on a quarterly basis, and they analyze it and say, ooh, commercial real estate, too much. They cannot say you cannot lend, but the directive will go down. So, all right, too much risk. Slow down in this area of lending. So this is a very dynamic process. Okay. The question on Lehman Brothers, different story. No, it's not over specialization. It's something very different. I'll talk about the investment banking a little bit today, but I don't think it will get to the Lehman thing. It's more of a taking the risk and having very little capital. So remember I said 10% capital equity? It's mandatory. It's regulated. Investment banks did not have to comply with it because they were not commercial banks, different regulation. Their equity was required minimum 3%, which is very, very little. So that's one of the reasons Lehman could not survive. Okay. So let's get into number two. What do you think about the financials that Red Hook presented to the bank? Anybody would like to take it on? Hannah?
I'm not going to read all our answer, but yeah, for me, I don't know how it actually works for banks, but for me it looks simplistic because there is no sensitive analysis, and the CFO in his CV, he worked as a credit analyst in the bank, and it was. It looks like it failed to do some sensitive analysis and what if not that optimistic growth will be, and it does not show how well the company could service the loan if something goes a bit wrong.
Okay.
And also another point about the first line, because it's the main line with the biggest sum. It combines two breweries in one, and we have in capacity one brewery is half times more than another. Yeah, but in if you look at the expenses at the loan needed, it's twice different. And maybe it should be like, I would separate it and for analysis, but in future projections we cannot separate them because there is no separate sales for one brewery and another. So it's not clear.
Okay. Did your group approve the loan?
Declined?
You declined? Because I didn't see. Okay, group 3 declined. Fine. So that's your kind of assessment that you think it was over optimistic. That's okay.
Because it's about also interest rate. So in these projections, maybe it's negotiation position for the company to suggest we need this interest rate, but we decided inside groups that it's too.
Okay, that's fine. Other groups that did approve. Leap, what group are you?
Yeah, the group 5. We did approve the loan, but also agree that the projections were very optimistic, and the 53% KGAR in 19 what's that 19 forgot 1991 that's 1994 compared to 1983 when they started to be profitable. It's too high, 53%. And the other thing is that they are also projected 40% EBITDA margin, EBIT margin, sorry, EBIT margin, which is also very high, and they in historical trading they haven't had such a margin. Yeah, they are building new breweries, and they might increase their sales much, but not as they projected, as I suppose. So our approach was, why do we actually agreed this loan? Because there is a growth, there is the new market, and if everything plays well, they will be like maybe not as in their projections, but they will be growing and will be able to repay the loan. So our approach was to increase the rate, actually, not 11.5, which is also higher than the market and than the normal rate for lending for the bank, but like maybe 12 or 13%, and also we would like to recalculate those projections and like lower them to 2% at least.
Okay, all right. Other groups would like to comment on the financial projections? Natalia?
Yes, thank you. I also could add that we approved this loan also as the bank, but we have some concerns, and we fully agree that
I'm sorry, what group are you?
Group 2. Yeah. So we fully agree that these like forecasts are fully very.
I think we lost. Oops. All right. Any other comments? Hopefully Natalia will come back. Anna?
Yeah, maybe I would like to add about collateral because it's part of the
Let
loan.
me,
It's not part of the projections.
Yeah.
Okay.
I'll talk about the collateral a little bit. So let me get into a couple of slides to kind of wrap it up. I'll talk about the interest rates. Again, this is very likely to be unfamiliar for most of you, the industry-specific things. So I look for financial analysis. The interest rate and approval, it's a little bit more complex because you don't have the kind of industry insight. So let me walk you through this, and I'll pick up here. So we talked about the FIT. So the bank is concentrating on C&I loans. Let's talk about the financial projections. And if you look historically, that's what the revenue, you have the historical revenue. It's a fairly new company. It's steadily growing. And then you see this projected explosion in revenue. What's the technical term for this? For this picture? It looks like what?
Exponential.
It looks like a hockey stick. That's what you play hockey with. And you will see this very often. When analysts are trying to predict the future, it looks very, very good. You know, your revenue exploding. All right. How reasonable is that? So let's look at one particular measure of the risk measurement, the interest coverage ratio. And that's what I ask you to calculate. All right. And remember, what's the interest coverage ratio? This is the EBIT, all right, divided by interest expense. Okay, so interest expense. So what does it mean to have a ratio of about 7? So you have 7 to 1. That means for every dollar of interest expense, the company is expected to generate $7 of operating income. Are you comfortable? All right. What about 20? Absolutely. All right. Even 5, in this case, you expect to generate $5 of operating income for each dollar of interest expense. How much do you have a margin of error? What if you off by 50%, which is a big, big adjustment? Would 2 to 1 work? Yeah. All right. So if your projections are, 50% inflated, and obviously you go through, you test it, you stress test it, you say, we're not going to grow this much, we'll grow half the rate. You still generate a pretty decent coverage ratio. All right. So in that sense, even with, this exploding growth rate, the coverage ratio is still pretty comfortable. From the risk point of view, it seems that this business, given the profit margins, everything, you've been conservative, you cut it in half, it's still what? It still works. Okay. So from that point of view, I think the bank should be pretty comfortable in extending the loan. There are some other pieces that are of a concern. And before I get there, let's talk about the interest rate first. The financials, again, over optimistic, but even with this picture of a hockey stick, you still have pretty good risk management here in place. Interest rate, that's how the income statement looks for a banking institution. So if you charge them around a prime rate, which is 11.5, and if you pay, this much, you calculate the debt portion of the funding, you calculate how much the bank has to pay, because remember, how banks make money. So you have the assets, loans are the biggest assets, you have deposits, and you have equity. So whatever you charge as a percentage on your loans, minus how much the debt cost you, that will generate the margin. That will generate the difference for the bank. That's the source of what? Paying for expenses. And this comes directly from the income statement of the bank. On average, they pay about 3.3% of the assets. Okay, so if they spend this much, 3.3%, if they provide, remember, when banks make loans, some of the loans will not be repaid. So if you look at the percentages in the income statement of the bank, about 1% on average is what? Unpaid. That's what on average, how many customers default on these obligations. All right. But deducting the cost of borrowing money, deducting the expenses on average for the bank income statement, deducting expected losses on average, they still make a 1% on assets. And remember how this works? If this is asset return is 1%, and equity is what? 10% of the total, what is your expected ROE? It will be 10 times that. So if you multiply by 10, your expected ROE is about 11%. That's a good ROE. Again, historically, what's the return on S&P 500 over the last 90 years? It's about 11%. All right. So it's a pretty normal return for a business to generate about 10, 11%. Again, it's a mature industry. We're not talking about startups generating 100% of return. It's a stable, mature industry. So you would expect this industry to generate, on average, what the economy is generating is about 10, 11%. Okay. So going through this exercise, if you generate 1% on assets, given the interest rate minus the interest expense, minus the cost of doing the business, minus expected losses, you still generate a little over 1% in assets. And that's how bankers speak. It says how profitable you are. I'm 1.5%. What does it mean? 1.5% return on assets. That's how people in banking industry speak. So 1.5% return on assets, it's about 15% return on equity, which is pretty good. All right. So that's how you think about the interest rate and the profitability for the bank. All right. Again, I didn't expect you to do this, so take a look. I'll post this. Take a look, compare it to what you've done, and make any corrections to this. Now, approval decline. And before I get there, let's talk about collateral. So let me wrap up the collateral. I'll come back to Anna. Again, banks, when they lend money, they like to have collateral, something of a security in case the borrower defaults. They can take something and sell it and recover the loan. All right. And different collaterals, different businesses, they have different collaterals. So a traditional collateral for a real estate. If it's a personal real estate, that's the house you buy. That will be the collateral. And what's the typical arrangement in this borrowing thing? A borrower has to put some his or her own money. Do you know the ratio there? Anybody familiar with a banking down payment? How much the banks ask you to put own money? About 20%. Okay, so if the house is $1 million, the bank will say, show me that you have $200,000 free money. And you didn't borrow it from somebody else. Okay? You have to prove that this is your money and here's the source of this money. Okay, so about 20%, that's kind of the typical. In the business, could be somewhat more, depending on the risk of the project. But in general, the down payment, the capital provided by the borrower, 20-30% would be considered to be reasonable. All right. And then the bank will finance the rest, about 70%, 70-80%. All right. But there must be a collateral to support this. Without collateral, so the business I am in is unsecured. So we give customers credit lines. They work like credit cards. There is no security. How do we cover this? With higher interest rates. Okay. We charge higher interest rates, and that covers potential losses since we cannot recover collateral. We don't have any collateral. All right. So what? So let me get into this thing. So what kind of collateral you can have? You can have accounts receivable. You can pledge your receivables as a collateral. So you say, you the bank, if I fail to pay, you will collect my receivables. Okay. And there is a process to pledge your receivables as a collateral. Inventory, same thing. Real property. You can actually provide your personal property as a collateral in personal loans. Okay. In this particular case, so let me demonstrate how this might work. So in this particular case, you have about $15 million in value of the equipment. You have the brewery equipment, you have some fixtures, you have trucks, you have some land improvements. So about 15 million total investment. All right. And the way it works is the following. The bank might say, okay, Lease improvements, I cannot sell them separately. There is no value there. Okay. But the brewing equipment, the bank will investigate, can we resell this brewery equipment? And they might determine that there is a secondary market for this thing. And on average, you can recover about 50% of the value. So this is the amount of that the bank might recover in case of a default. Trucks, $100,000, they say we can recover 50% of this. Furniture, that's not sellable, so there is no value there. Okay, but even if this we call it the haircut, where you do a haircut, 50% of the total value, even with this, you still have more than expected loan of 6.5 million. All right, so the bank might get in and put covenants. So what's a covenant? Covenant in the loan agreement, the borrower signs the loan agreement, says here's the loan amount, here's the interest rate, here's the payments, but here's the list of covenants. What's a covenant? A promise to do something, not to do something. That's where I ask you to read the background note on the loans. And a covenant might say something like it is a positive and negative covenant. It doesn't mean good or bad. Positive means do something. So you must submit financial statements once a year. So do something. That's a positive covenant. Okay. And in the financial covenants, your interest coverage ratio cannot drop below 2. So $2 for each dollar of interest expense. All right. So that will be a financial covenant. Do this, positive covenant. Negative covenant, do not do something. You cannot borrow from another bank without our permission. So that's a negative covenant. Okay. You cannot spend money on doing something that is not related to the project. You cannot take this loan and spend it not on the brewery, on something else. So the purpose of spending must conform to the loan purpose. Okay, so do not spend on anything else. That's a negative covenant. All right. How does this covenant work? So let's say I talk to those bankers, the business bankers in that location next to my home, and I cannot talk to them in January. Why? Because in January they collect financial statements from their borrowers and they calculate the ratios. What if the covenant says the minimum coverage ratio is 2 and it's 1.5? Well, formally, the borrower is in breach of the covenant, and the bank has the right to recall the loan. You owe me all of the money right away. It's in the loan agreement. That's what the covenant allows you to do. Do you think the bank will call the loan? But that gives the banker the following rights. They will literally show up at the premises. They will look through the financial documents and say, what is this first-class flight from San Francisco to New York? Why are you flying first class? You in breach of the covenant. No more first class. You flying coach. Until what? Until your ratio goes to 2. You see how that works? So that gives the lever to the for the banker to what? To change the behavior, to save money, to cut off any expenses that are not needed, to what? To save money and push up the ratio above 2, which is in the covenant. So that's the purpose of the covenant, to have the bank the right to change the behavior of the borrower. All right. So that's how the arrangement works in borrowing. Let me see. This is the. I give you the list of potential covenants. So you have the the requirements. You cannot do some other things. So you cannot sell your assets without our permission. So that's the list of the covenants. I'll talk about five. I don't want to rush through this, but 5 C's of credit. I'll come back next week. And what happens with this particular case? That's a real case. That's a company, a brewery, was trying to borrow money and expand their business. And there is one key requirement. Remember that I said the borrower must put in their own money into this project. And in the case, it mentions something, a European company is providing what, equity investment? That's the own money. And what happened in this particular case? The European company did not go through, did not provide the equity. And that's one of the key requirements. So what happened? The Red Hook was unable to get the $5 million in equity. Okay. And remember, they needed about 16 million total investment. So the bank said, no. If you don't have your own equity, we cannot give you the loan. So even though it looked pretty good, this requirement, the capital requirement, was not fulfilled, and that's what the kind of killed the deal. They came back. They got a partnership on Anheuser-Busch. That's a big brewery. They took 25% equity position in the company. They made a big investment in the company. And that was enough for them to come back a few years later and borrow money, but build a brewery not in California, but in New Hampshire on the East Coast. All right. And the company eventually went public. And that part, I would like to spend a little time next week talking about investment banking, how they help companies raise capital. Again, it's more of a qualitative discussion, but for the borrowing, I think you've got a pretty good idea how this works based on this case. I'll post this summary. You owe me a 1-page summary by the end of Saturday. That's your last group case. The quiz will open after class today. Again, review the solutions to the evaluation process. There will be evaluation questions on the quiz. 3 questions. You will have 2 hours. I extended a little bit, but again, as soon as you open the quiz, you have 2 hours to complete it and submit it. Okay, exactly the same process as you've experienced with quiz 1. Okay. Start working on your individual assignment. We'll do the discussion on the dividend policy and the corporate restructuring next week. So read those 2 cases. No submission is due. The quiz is due by Tuesday. So start working on your individual project. And if you have any questions, reach out or bring your questions to the next week's meeting. All right, Tatiana.
Yes, thank you. I just wanted to ask, you stated that usually it's 20%, like a bare minimum that a company should put their own equity. But you also mentioned that it can differ, like depending on risk rate or something. Can you tell a bit more what other like variables are a part of this equation, let's say? Which is the ratio between equity and like?
All right. So something that will be part of this summary, and I would like to spend a few minutes next week. I don't want to rush through this, but I'll show you the consideration, how banks make those decisions. And this is called something called the 5 C's of credit. Okay. Why it's called 5 C's of credit? You have 5 different things that determine if the bank will lend you money. And each one starts with a letter C. That's why it's called 5 C's of credit. First one, and the most important one, is a character. What does that mean, character in banking? Bankers are not looking for nice people. So if you help the old lady to cross the street, you have a nice character. Banker doesn't care. What's a nice character for a banker? And you mentioned this. Remember, this is a long-term customer for the bank. They had a relationship. They borrowed money from the bank. They repay those loans. It's a good character. That's what it means in banking to have a good character. So if you have this long-term relationship, this is a big plus. All right. Now the other, so let me briefly walk through. I might repeat this next week. Capacity. Do you generate cash flows to repay the loan? So this is your financial analysis. Capital, this is your 20% down payment, 20 to 30%. Okay. Economic conditions. Remember I said, do not lend to hotels. So what happened in January of 2020? If you are in a hotel in good standing, you have wonderful character, you have long-term relationship with the bank, your project, you're building a new hotel, you generate free cash flows, fine, you have a big down payment, economic condition. In January 2020, you get a loan as a hotel. In April of the same year, do you get a loan? Anybody remembers April 2020? Anybody stayed in a hotel? That's the pandemic. Nobody will go to a hotel. So economic condition changed. You're not going to get a loan if you're a hotel. But if you are a delivery business, you'll get a loan easily because that's the demand. There's a lot of demand for delivery, and that would be economic condition to your benefit. All right. And the last one, but not least, is the collateral. How much collateral do you have? So that's the considerations. Again, I'll come back to this next week. Did it answer your question?
Yeah, thank you.
All right. Anastasia?
I wanted to ask you about the financial statements of banks, what we discussed at the beginning of the class. So I have a question about credit cards. So if I use the actual money on my credit card, the bank's money, that I understand is I'm essentially taking out a short-term credit at the bank. But what if I don't use that money? It just like sits there available to me. Where is it reflected in the statement?
Give me a bit more. I'm not quite follow you. Give me kind of expand on your question. When you borrow money.
Yes, that I understand. That like, say I have a credit card with $1,000 limit, and if I use $500 out of that, that's essentially bank's asset because I owe them money. But what if I don't use that money? It just sits there as a limit available to me at any time. Where is it reflected in the statement? Is it a liability for them because it's available to me, or what is it for the bank?
I'm teaching a banking class in Copenhagen next summer. It could be a very long answer. It's called off-balance sheet liability. Why it's off balance sheet? Because it's not on the balance sheet. So if you have a credit card, your limit is $10,000. You borrowed $500. $500 will be on the balance sheet of the bank. But if you have another $9,500 credit line, you can take it anytime. So potentially it could be on the balance sheet of the bank, but it's not on the balance sheet, so it's off balance sheet. But the bank must be prepared to lend you that $9,500. They are obligated because they promise you $10,000. Okay, so they must have risk management to make sure they can lend you that money and they do not take a lot of risk. So that's what we do. My main product in small business lending is a credit line. It works exactly like credit card. And that's exactly the scenario that you described. So let's say a business has $100,000 credit line and they borrow $10,000. Well, what about the $90,000? It's not on the balance sheet, but it's what? It's a potential risk to me because a borrower can come in and we are obligated to lend another $90,000. Okay, so this is formally off balance sheet liability.
Thank you.
Other questions?
It's interesting because in that short like explanation how banking works, they write that there are like fees or premium for such commitments. But in Ukraine, you usually, at least for personal purposes, you get loan limits for 50, 100,000, and you don't pay anything for it. Moreover, you could use the money, return the money till the end of the next month and don't pay any commissions.
That's very typical for small businesses. So in our product, we call it evergreen line of credit. That means doesn't end. There is no maturity. Evergreen. It's only if the customer defaults, we can close that line. Borrowers do not pay anything on the money they did not borrow. But if it's a large business, they might have a credit line of $1 billion. It's a potentially big liability for the bank because that business can take that $1 billion at any moment. So you typically have something called the commitment fee. So a large business will pay like 0.5% based on the line, not the actual balance, for the commitment. Right? So the bank will generate some revenue based on that commitment. At least that covers some of the risk. Okay, but for the smaller businesses, typically smaller businesses do not pay a commitment fee. And large businesses, if they borrow money on a credit line, they must demonstrate that they can repay it. So once a year, the balance has to go to zero. You cannot keep it for more than a year, right? So that's a typical arrangement for the larger businesses on a credit line. Make sense? All right. Any other questions? Again, the Q&A next week. I will wrap up with the dividend policy and that Mark Kerr-McGee discussion. But do send me an email if you have something you would like to discuss next Thursday. All right. Again, I'll stick around for any questions, but you're free to go, and I'll see you next week.